We're now going to talk about economic statistics. And what we talk about here, the Fed forecast as of March 16th, we see that it raised its inflation projections for 2022 and 2023, that the December projection was for 2.6%, and we're now up to 4.3% inflation in 2022. And what this has done by raising that inflation projection by, was that about 1.7%, it's reduced the real GDP growth by about 1.2%. So GDP growth is actually going to grow more, but on a nominal basis, but not on an inflation adjusted basis. The unemployment rate they project will continue to stay about where they were thinking, 3.5%. And in the longer run, after Biden's first term, they expect the unemployment rate to go back up to 4%, which is still very low based on historical standards. Core PCE inflation, again, they're projecting it to be higher than they were projecting it last year. And the federal funds rate, again, they're projecting it to be substantially higher than they were projecting as recently as December. We're looking at still pretty good growth. The GDP number for the first quarter of 2022 will come out, I don't know whether it's next week or the following week, but anyhow, at the end of April. And at that point, we can figure out what was the GDP growth during Biden's first year from the first quarter of 2021 to the first quarter of 2022. But otherwise, we've got numbers that look good on jobs growth. And assuming that the trend continues on the budget at the end of his first fiscal year, budget year, at the end of September, the deficit will come down. Now, why did the inflation number go up so much in March? What happened is the monthly inflation for March of 2022 was 1.2% on a seasonally adjusted basis. A year earlier, March inflation was 0.6%. So when you do 12 months of inflation, the March 21 number goes away and the March 22 slides in. So you've got 0.6 of a point higher, percentage point higher, which is why it went from 7.9% to 8.5%. And, the big driver was gasoline. And there were other things that also increased, but again, the big driver was gasoline going up 18.3% with the war in Ukraine, the price of crude oil going up to $130 a barrel. If anyone's paying attention, they probably noticed that the price of crude oil has come down. I think the last I saw earlier today, West Texas crude was about $104 a barrel, and Brent crude was about $108 a barrel. And the price of gas, which peaked in early March at $4.31.5, has come down as well to under $2, $4.10 a gallon. So we're starting to see things drop, and that's one reason why I expect that we will have lower inflation on the 12-month numbers in April than we do in March. Core inflation was relatively flat last month, but all items, which includes food and energy, was what helped push it from 7.9% to 8.5%. I think core inflation went from 6.4 to 6.5%. And if we look at what were the big things driving things last month, energy is the big one. Food was fairly substantial, especially food at home. Restaurant food inflation wasn't all that high. And all items less food and energy last month were at 0.3%. So if we duplicate that this coming month, have energy prices coming down, offsetting any increased food prices, we should see the 12-month inflation number coming down anywhere from 0.3 of a point to 0.5 percentage point. My going out on a limb prediction. You notice another big thing was over year is used car prices, but the last 2 months, they've actually been coming down. And this is investor inflation expectations. David, I'll let you take the lead on this one.
Thank you, Carl. I mean, they have plateaued, it looks like, fallen a little bit in the case of the 5-year break-even inflation rate, the red line. So this is really telling us what investors think inflation is going to be on average over that period of time. So whether over the next 5 years, they're thinking it's going to be like 3%, and over 10 years, it's going to be more like, 3.3, over 10 years, more like 3. So these are still elevated. If you look at the history, it's been more like 2%. And I think the Fed would like to get that down, but they watch this measure very carefully. And if this is where they start making decisions around, they're going to do a 0.5% increase or just a 0.25% increase in the Fed funds rate, the interest rate that they manage. That's where they look at these expectations, because if those expectations stay up, they're going to be taking more aggressive action. This is one of the measures that they're going to keep beating on that interest rate increase drum until these numbers come back down.
And euro inflation is a little bit below ours at 7.5% versus our 8.5%. And their big driver is energy, especially in recent months with the war in Ukraine. It may be that Europe has by the time we get to April, Europe may have a higher 12-month growth rate than inflation than we do.
And there's a lot of Republican criticism, as you might imagine, around inflation going at Biden. I see it all the time on Twitter. It's one of their main things. They're just hammering away at inflation. Just keep in mind that, and they're blaming Biden's policies, of course, the Rescue Act. Paul Krugman said, I think it was about a month ago, he said that the Rescue Act was maybe 1 percentage point of the 8.5 in the U.S. Maybe 1 percentage point of that was the Rescue Act. And you can see here that Europe also is experiencing inflation, also driven by energy, very similar to the U.S. So it's a global phenomenon. It's not just here. And the reasons for it, there are a lot of them, and lots of different views on how to weigh different factors. But and we'll talk about some of them. But it's energy, not only here but over there as well, and it's global. So to blame Biden for policies where they're causing a global problem is a bit far-fetched.
Okay, so from the beginning of the pandemic, they're measuring from February of 2020, pre-crisis, inflation is up 11.1%, and hourly wages are up 12.6%. So we've had real wage gains, not counting all the checks and other things, that went into income that are not part of wages. However, a lot of that was prior to Biden taking office. So since Biden took office, we see that inflation has gone up a little more than wages. And again, the wages don't take into account the $1,400 checks and things like that, which tend to offset it. So that income has probably exceeded inflation over the 14 months that he's been in office. But those $1,400 checks are history. So if inflation continued to rise as fast as it did this past month, that would be a real problem, because wages are not rising at that level. In fact, wage growth has slowed down a little bit, but again, core inflation was at 0.3%, so wage growth at 0.4%. If fuel and energy prices come back down, these still are decent wage gains. Gasoline prices, 10-year nominal highs and maybe all-time nominal highs. I'm not sure. They might have been slightly higher back when my brother had us take our Route 66 road trip. But what you see is that the price of gas has been coming down nationally over the last 4 or 5 weeks. Some gas prices are sticky. in my neighborhood in Chicago, 468.9 is about where it's been for the last 4 weeks. On the other hand, I filled up in Schererville, Indiana at 398.9 over the weekend. And over the weekend, a price in Crete, Illinois on 394 heading down towards Crete, I saw it drop from 449 to 419 over the weekend. Just, a big drop to compete with the other stations that were on that road. So with gas prices coming down over the month, that's why I think inflation is going to come down over the month, the month of April, because they measure prices not at the end of the month, but in the first half of the month. Minutes of work to pay for a gallon of gas, it's gone up, but it's nowhere near the high over the last 30 years. And this was gas prices were trending up prior to the invasion by Russia of Ukraine. And this is showing that the premium based on that invasion was 49 cents.
Yeah, it got as high as 70 cents at one point. But right now it's in that 40 to 50 cent range. Just, if you're wondering, I call it the Putin premium. That's how much more you're paying at the pump. And again, the Republicans are driving hard. They're talking about gas prices again constantly on Twitter. About 50 cents of that increase is not Biden. It's directly, you can see it directly because of the invasion.
And they seem to be arguing that Biden's policies have cut production, and I think I showed it last month that that's just not true. That production was higher in the second half of 2021 than it was in the second half of 2020 under Trump. Mortgage rates, well, this will slow down some of the economy. All the people that were, refinancing, taking cash out so they could go spend money, made a lot of sense at a 3% refinance. I'm not sure how much sense it makes at a 5% refinance. So this is likely going to have tamped down GDP growth, but also tamped down inflation on other things. And now we have the interview with Larry Summers, which I'm going to let David take the lead on, and I will stop.
All right. So Larry Summers, he's one of those economists you love to hate. He was calling for inflation, expecting inflation to rise, not necessarily for the right reasons, but he's been getting a little bit of extra attention because he was correct in warning that inflation was going to go up. He gets away with it, and we'll talk about his philosophy here. It was a really good interview with Ezra Klein in the New York Times. If you can access it, I highly recommend reading it. There's a lot of interesting things to learn, whether you agree with Summers or not. It was very thought-provoking. And so let's go through some of what he said, and I've got his own words and then the short form, my interpretation in blue over there. But first big idea is that the idea that supply is fixed in the short run, meaning you'll hear a lot of people right now saying demand isn't the problem, it's supply. We've got bottlenecks. We're not producing or are able to transport enough goods as quickly as demand would indicate, and so demand is higher than supply. Prices are rising. It's a supply problem. Summers' view is you take, as a policymaker, meaning you're at the Fed, you're in the federal government working on advising the president about how much to spend or how much to tax, generally how much to spend is more realistic these days. You take the supply as a given and then you manage demand. You're a demand manager, you're not a supply manager. So even though Biden was talking about ways of lifting supply, that's a very long-term thing. In the short run, you take supply as a given. And not everybody would agree with that necessarily. I just wanted to make sure that is Larry Summers' view. And if you start with that premise, then you have to figure out the Fed needs to be raising rates or doing less with its QE program, and the government needs to be raising taxes or cutting spending, lowering the budget deficit, which, as we talked about earlier, is definitely happening. The budget deficit is falling dramatically. So that's the number one of what he talks about here. And then this statement right here. So the job of the demand managers, principally the Fed, is to judge what supply is and calibrate demand appropriately. Demand I inserted talks about it up here, but it's the reality of the situation. That's how you live with it. Number two was, this was somewhat surprising to me because other people have argued, like Krugman, that isn't the driver. He says that over the long run, it's wages that are really driving inflation, meaning you can't have inflation that lags dramatically behind wages over a long period of time. It's always going to catch up because businesses are going to figure out that people have money, is a simple way of explaining it. If they know that their customers have more money, they're going to raise their prices and they're going to be able to sustain that. And that's part of what's happening here. You've had very strong wage growth. Carl shared 2 slides. In one case, we've got more purchasing power now than we had under Trump. And 2019 was an incredible year from an economic perspective. As I mentioned earlier, it's records on a ton of different variables in terms of levels. And here we have, the wages are growing well above that. The real purchasing power was higher measured against February 2020, which is sort of the last pre-crisis month, or pre-pandemic month. So he's saying wages are a big problem. So that slide that we just shared with you that showed wages coming down is a good thing from a Larry Summers perspective in terms of easing up some of those inflationary pressure. The next part is and these, by the way, are separate paragraphs from his interview. They're not in the same sequence as in the interview. The Fed has to get in front of inflation in his view. So in the past, what used to happen is when the Fed was worried about inflation, they would raise rates. They would anticipate inflation. Whoops, we think we're going to get inflation. We're going to raise rates now. The philosophy change under the current administration, the current Fed chair, has been, we will let inflation run hot for a while. We're going to see how well we can drive wages and wage gains. So some of this is a success, if you will. A little bit, they probably went a little further on inflation than they wanted, but they did not. The old way you used to say it is you take the punch bowl away just when the party gets going. That was sort of forget who came up with that metaphor, but that was probably Alan Greenspan. But it was one of the ideas was you take away the Fed takes away the punch bowl right when the economy gets booming. What the latest Fed interpretation is we're not going to do that. We're going to leave the punch bowl, let people get a little crazy, and then we'll deal with it. And Summers is more of the old school. He didn't like that idea. I think he would have been more comfortable with the Fed getting in front of it. To him, even though the Fed has a dual mandate of employment and inflation, he's more on the side of make sure you keep inflation down. And if you get an occasional recession, then, deal with it. He's saying right now the Fed needs to take much more aggressive action. So raising interest rates quite a bit. And I'll share with you shortly how much he thinks that should be. He gives a little history lesson here of, back in the 60s with the Vietnam War, we had some inflation. There was you had the war. There was a lot of spending going on different government programs. It was a little bit more of a philosophy, kind of like this recent Fed philosophy of let the economy run hot. And it really, that school of thought ended with stagflation in the 70s when you had all these supply shocks. You had oil prices going up, you had wars in the Middle East and the U.S. There were, I believe it was embargoes or partial embargoes from Saudis and others for us helping Israel. So you had a lot of reduction in the supply of oil. And back then, oil was even more important to the economy. If you think about the transportation of goods, if you make that more expensive, the price of everything goes up. And oil was even more important back then. So he seems to be saying, I learned those lessons, and I wasn't going to get on the side of the idea that you let the economy run hot. It's the Fed's job is to make sure that inflation doesn't get off the chain. It doesn't get unhooked. And he's saying, there's still time to act. The Fed can dramatically raise rates over the next year or two, and better to do that than do what Paul Volcker did in the early 80s under Reagan, which was 15% or whatever rates of double-digit interest rates to try to kill off inflation. And that he's usually given credit for solving that inflation problem by creating two really bad recessions, near back-to-back recessions. There's another argument that what really got us out of those recessions was that oil prices went down again. It wasn't that he jacked up interest rates, it was that oil prices came down. But we're not going to go through that debate here. Just wanted to say that, he is very much let's not do the Volcker thing again because we don't want to suffer like that. And he reminded people that in the early 80s, you had an unemployment rate that actually got higher than the unemployment got in the Great Recession of 2007 to 2009. Unemployment rate was higher in the early 80s under Reagan than it was under Bush and Obama in the Great Recession. He's saying, let's not go there again. Let's get in front of this now. And he's saying that there will be consequences of that. The consequence is that he doesn't believe that you can reduce inflation and maintain incredibly low interest rates. He feels those are incompatible, meaning if you're going to raise interest rates a lot and slow demand in the economy significantly, you're going to raise the unemployment rate. It's almost impossible his view is you can't engineer maintaining a record low unemployment rate. 3.5 is like the 50-year record we had right before the pandemic, and we're at 3.6 now. To be able to maintain that low a level of unemployment and raise interest rates enough to get rid of inflation, he says there's no historical precedent for that. That would be a new thing if that happens. And he gives a couple statistics down here. If you look at the last 75 years of history, if the unemployment rate is below 4 and the inflation rate is above 4, you're looking at a 50% chance of recession in the next year, 75% chance in the next 2 years. So his view is we're probably going to get a recession if the Fed does the right thing. If the Fed does the right thing, we'll still get a recession, but it won't be a Volcker-like 81, 82 or 80, 82 recession that we had. But it's, again, reading the words, I don't want to read these out loud to you, you're adults, but that's the gist of it. This presentation is available to read through it all, but I think it's a very informative what he had to say here. One other thing I don't have let's see if we have it here. It's down in this area. I might have taken that extra slide out. He said this, is that right now, you saw that mortgage rate going toward 5%. And if you look at most real interest rates on Treasury bonds are negative, meaning the inflation rate, 8%, and the Treasury bonds are like 2, 3, 4%. That's a real negative rate of interest. He's saying the Fed is probably going to have to raise interest rates to where you have a positive, you might have a positive interest rate, meaning that the Fed might have to get rates into that 5, 6, 7% to be above those interest rates on the Treasury bonds. So I think he's more of the school of let's do 5%, let's get interest rates up towards 4 or 5%, Fed rates up to 4 or 5% to make sure that we don't have to go to 15%. So he's definitely on that austerity side and pretty hardcore sooner rather than later. So any questions about all that? I know that's a lot to digest.
Well, the thing he's ignoring in that 75-year history of business cycles is the fact that almost all those recessions started under Republican presidents.
Yes. Our favorite statistic, 10 of 11 of the last 11 recessions started under Republican presidents. And Carl, what's the one you always add about how far
the corollary to that is every Republican president has had a recession start in his watch, going all the way back. The last Republican president who did not have a recession start in his watch was James Garfield in 1881, who served 6 months before he.
I just love that. That's
so great. If you want a recession, elect a Republican president. How the Republicans have this reputation of being good for the economy, there's one outlier, Reagan. And that's it.
Yep. One thing, no, that's great. And one thing just to add on Reagan, one is he had an economics degree, as my understanding. And two is that he ran huge deficits. As much as people like to talk about that, he not only did he cut taxes, but he dramatically increased spending. And so he was a Keynesian kind of old school, let's have a big budget deficit along with these giant high interest rates to try to, get through this thing. But he did not. You had the Fed doing something different than him, meaning he wasn't doing austerity. He was doing big stimulus while the Fed was doing a gigantic interest rate hike. So he wasn't gonna, he was doing what a Democrat would have done in theory, is dramatically increase the deficit, what Keynes would recommend. He was not insane from that perspective of being a crazy austerity guy. He ran big deficits. His spending, and I have to look at the exact number, but when you look at the presidents and how much they spent relative to the size of the economy, Reagan is number one by a tiny amount over Obama. I think Trump has taken over the lead now, but up through Obama, Reagan was the biggest spender as a percent of GDP. Obama just a hair behind him, like a tenth or hundredth of a percent. That's somewhere in that 22% of GDP range. We probably got it buried in. We got it here in one of our slides. I know we have it in one of our presentations.
Remind people about the great jobs records under Republican presidents. Can you see my screen now?
And there was something that the Democratic Party was sharing that said something like 90-something% of job creation going back to.
Well, after Reagan.
After Reagan was by Democrats.
Yeah, because
the Republicans added almost nothing. Yeah.
Yeah, Bush and Trump offset each other, and so you have the little bit of gains under George W. Bush compared to the gains under Clinton, Obama, and Biden.
Democrats, we carefully guard these secrets, and it's up to people like those in this group that have this data, share the heck out of it. I mean, get it out there because they need as much help as they can get.
Certain things are looking good. The positives are the stuff that's in blue. Stock market's up, household net worth is up, median sales price of homes are up. PCE is an inflation number, right?
No, this is the consumption of personal consumption expenditures in GDP.
Okay. But the inflation being up 10% over the course of the 14 months is not a good thing, although wages are up. I guess these are all since February of 2020.
Or quarterly with some of the GDP data from the fourth quarter of 19.
Yeah. So despite the big trough in 2020, real GDP is up. As I said before, the first quarter GDP number will come out within the next couple of weeks. The labor force is up a little bit in terms of raw numbers. Unemployment rate is up 0.1% on the U3 and down 0.1% on the U6. Service consumption is down a little bit. The employment to population ratio, so we have the raw numbers up here, the ratio, and the overall jobs level is still down a little bit, although, as we pointed out, full-time jobs are actually up. So there's a lot of good things happening in the economy other than the inflation number. And if the inflation number starts to come down, like I think it will and hope it will, if gas prices come down, then I'm not sure. Hopefully we can convince the general public that the economy under Biden is actually pretty darn good.
And bear in mind, these things are relative to the incredibly strong 2019 economy just before the pandemic, meaning stock prices are 40% better than that. And that 40% is not measured from the trough. That is measured from before the trough. So from the trough, the stock market is up about 70%. So this is how much better the economy is now than under roughly the best time under Trump, or where it stands relative to that. So these labor statistics toward the bottom are pretty much right where they were under Trump, extremely close at the end of that, the best time under Trump, right in that 2019 peak. And these other metrics along the top are way better. So again, even though inflation is painful, the wages are up even more when you go back and compare. So this, Americans are by far richer than they were under Trump in 2019, based on those first three measures at the top there. And then we'll talk in a little bit about the checks and other things and how those help households all up and down the spectrum. But these aggregate measures, this is a heck of an economy right now, with the negative of inflation mitigated to a great extent by wages.
And I just read the notes in the bottom right, which gives the time frame for each of the various statistics, which I think you told us orally, but when people come back and look at this chart, that's useful to know what dates we're measuring from.
Yep.
And our GDP growth from the fourth quarter 2019 compared to some other countries that we compare ourselves against, the G7 economies, we're looking pretty good. Overall 3% growth during a period where we had a 20% shock down, or whatever it was, is, we've recovered from that. We're doing pretty well. All income groups saw big improvements in their financial situation in 2021. That was the major checks that came in, and as well as, income versus inflation, was not bad. So oddly, the 60th to 80th percentile has some of the weakest savings growth.
I wonder if that was because only some of the people in that group got checks. I don't know the answer. I'm just guessing, but that 80th to 90th, just because of the amount of, I don't know exactly. I guess the 80th and 90th, those groups just normally would spend a tremendous amount on services, and they didn't probably. The saving was a big part of why why they've got more cash in their bank accounts. But what this means, though, is the famous Reagan question he asked Carter: "Are you better off than you were 4 years ago?" Here, the answer is: "Are you better off than you were a year ago?" The answer is a stunning yes by a heck of a lot at all income levels, and mainly because wages nearly kept up with inflation, and you've got checks, got the child tax credit, you've got people saving rather than spending. And I mean, there's a lot of reasons why households are in really tremendous position right now. It adds up to like $2.5 trillion more in bank accounts than we had in 2019.
Well, ignore the fact that if you looked at real median incomes in 1980, the correct answer was yes, we were better off than we were in 1976. And in 1984, the correct answer is no, we were not. But Reagan sold it.
So I didn't watch that debate. Did Carter respond to that question, or what happened? I've got to look at the film. I don't remember.
I don't have a recollection myself. In any case,
I have to look that up. Yeah. All right.
But
you need a better answer, Rob.
This is again saying that inflation is not, eating into most people's paychecks, so they're hurting. I mean, these are averages, not everybody. So there are certainly people who are hurting in the economy, but that by and large they're the exceptions. Consumer sentiment. Well, this is on you. For some reason, I don't put much stock in this, but that's just me.
Me either. But yeah, the basic idea
the consumer
Michigan
sentiment has gone down.
By this measure, I mean, it's one funny thing about it, and Paul Krugman asked the question, this is from some Twitter stuff that he did. He's like, are we in as bad a shape as we were in the Great Recession? If you look at that blue line or even the gold line, these are extremely low. Like, people are very negative on the economy, according to this Michigan survey. And they ask like 50 questions of 500 plus people. They've been doing this for a long, long time. So this is this measure gets a lot of play. But this is extremely negative considering the slides that we've been sharing with you, that people have more money in their bank accounts. The economy is booming. There's the unemployment rate is incredibly low. And yeah, there's inflation. But I think this is a function of an incredible amount of media focus on inflation and not talking about the boom that is arguably causing that inflation. Inflation doesn't just spontaneously emerge by itself. You kind of need a booming economy to create it. But they're all only talking about the inflation like this is a plague it's just come out of nowhere and it's all Biden's fault and it's just doom and gloom. And some of this is probably pandemic related, but still, it shouldn't be all pandemic because those numbers were a lot higher when the pandemic was worse than it is now. I think this is really the impact of media just hammering inflation.
I mean, most of those low consumer sentiment numbers are during recessions. And today's are not. We don't have a recession, and I don't think we're going to get one at all this in 2022. Hopefully we won't get one during the Biden presidency, but that's, still to be figured out. Krugman talking about consumer sentiment, but again, I feel free to go back and look at these slides.
Yep. Yeah, I mean, Krugman's saying if you use a different survey, the Conference Board, it looks a lot better. So, and this one, yeah.
Well, this one's interesting. You look at Biden's job approval, it was never very high under Republicans, 11%, 12% peak, and it's now down to 5%. And you're probably not going to get this group to recover in terms of its Biden job approval. The Democrats going from 98 to 84 is problematic, but this group, should be able to get back up over 90. And the independents going from 61 to 38, I think there's a good chance that the independents, if the inflation rate starts coming down, Biden's job approval among independents will start going up. And it's just a question of whether it happens soon enough to get that group of people swinging in the right direction. But we need to, if the inflation rate does come down, we need to publicize that. And when the budget deficit comes down by over $1 trillion, it'll get announced in October, just a few weeks before the midterm elections. We need to make sure that that's not ignored by the media, that what the Democrats are doing to manage the economy, good job growth during big deficit reduction is a positive.
And don't get discouraged when you hear the polls saying, Biden is unpopular as any president, blah, blah, blah. Just look at the Democratic numbers. The other numbers, I mean, they matter, but that's the number that, you're, like Carl said, you're not going to get much out of the Republicans. It's just, he has 84% approval among Democrats. That's a solid number. And then let's hope we can get into the 90s. If it'll be interesting. I think a big strategic decision he has to make is, does he want to forgive student loan debt before this election, or does he want to keep it for 2024?
I think he made a move on that today. Yeah. I saw a headline in a story that said that his move on student debt is not to forgive it, because he doesn't think he can do that unilaterally. But what he can do unilaterally is, we have the student debt forgiveness programs, and he's making steps to allow many more people to participate in that. If you've made student loan payments and you weren't in one of those programs, the payments you've made prior to this can count if you sign up for those programs. So that, and some millions of people, based on, they're going to go ahead and recapture all of their payments. And I think like 3 million borrowers are going to find out that all of their loans are now forgiven. So it's not a dollar amount that's going to be forgiven, or the total 1.7 trillion, but it's that hey, we are going to go ahead and forgive debt based upon these programs for lower income people who are
Yeah,
paying
there's
an X
a-
percentage of their income.
Yeah, there's a lot of action that he's been taking steadily on this that are sort of running below the radar because there are things that are sort of administrative and things that aren't getting a lot of press attention, but there are a bunch of them and they do add up. So we'll see. I think the big gesture may be required to help whenever he chooses to do it, if it's 22 or 24. There's a secret memo that has not been leaked yet, but apparently it exists, which is the education department's lawyers telling him whether he can or can't do it unilaterally. And that memo has not been released to the public. I think you're right in that his view has been it should be done with legislation. But quite a few people, including Chuck Schumer, think he can forgive it on his own.
Yeah, I don't think so, and I don't know the courts. Oh, two things. Number one, I don't think the courts would necessarily allow it to hold up, and they might find it to be an illegal act. And I think adding 1.7 trillion to the deficit is political suicide. So, just my opinion. But
We'll see.
if Elizabeth Warren and others keep saying he's, despite all the things he's done to forgive student debt, we need him to forgive $1.7 trillion unilaterally, and that becomes the headline going into the election, we may not reach, and get these numbers for the Democrats and the independents to rebound.
Yep. I bet they are doing a lot of polling right now, trying to figure out what strategy to go with. It seems like they're going with deficit reduction for now, based on that budget language.
Yeah. Okay, so, and this is, how is the U.S. president felt by international leaders or the citizens of these countries? But in any case,
They like him they like him better than Trump.
yes. Certainly they liked him. They liked Biden a year ago. It would be nice to see updated for this year, but I think we would still find that they like Biden better than Trump. And
yeah, not everybody dislikes our president. Our independents are meh on him, and the Republicans, of course, hate him. But the Democrats are in that 85% range, and so is much of Europe is up there too in the high 70s. So that's good.
Is this the Rick Scott plan to?
Yes. Yes. He gave us a gift. I mean, the Democrats are starting to get on the marketing bandwagon on this thing too. I mean, the Republicans are saying they're going to raise taxes on poor people and the middle class. And it's very interesting, their logic, which as best I can understand it, is the view that not everybody's paying their fair share. There's a lot of these freeloaders out there, never mind that they're paying all kinds of other taxes and to a larger share of their income than the rich, but that they deserve to be taxed as if they've got this money. So they're talking about this proposal, and Democrats are saying, hey, great, you guys keep talking about it, and we're going to keep telling everyone that you're talking about it, because it's about $1,000 for families in that bottom 40% each year if this were to be enacted. And there's a lot of other crazy stuff in his plan. It's somewhat vague, so the analysis I've seen has been kind of hard to really get my arms around. But the tax piece has been scored here by the Tax Policy Center, which is a reasonably nonpartisan. I mean, they're middle of the road fairly, so they're not crazy left or right. And this is a big chunk of change for poor people to handle. And remember, the Fed always talks about it's hard for the bottom 40% of families to come up with like $400 if in an emergency. They got to sell stuff. So this is a heck of a lot of money. I don't know why Scott is saying this. I don't think Mitch McConnell has gotten on board with it, but I think a lot of other Republicans keep talking about it, and it's just dumb. I don't know why they're doing it.
Well, one of the big problems with the Republican this year, and we'll have to see how this plays out politically, is the McConnell level and the McCarthy level. They don't want to have a platform to run on. They just want to run on freedom and anti-Biden. And we're going to run against Biden's economy because of the high inflation. And that seems to be about the only thing they're running on, other than social issues. Of critical race theory and
Yep.
Common Core
And always
math down in
immigration.
Florida.
Oh, yes, and always immigration, but various crises at the border, which I wonder what those are. The only crisis I can see at the border is that we've got 10 million job openings and not enough immigrants to fill them.
Yeah, how's that going to play politically this year? Policy-wise, it would be a good move to allow a lot more immigrants in to take those jobs. But
Yep.
politically, is more problematic than the policy.
Yep.
And this is why elect
Yeah, I mean,
Republicans.
I just wanted to bring that up because the media doesn't seem to act, when you look, it's very frustrating to look at articles, even in the New York Times, where it's like Democrats are going to lose big in November, no matter, they better take serious action and get BBB passed or some other part of it, or else they're doomed. I mean, my question is, why would you consider Republicans a good alternative? Like, why would you want them back? And the media doesn't seem to want to ask that question. They seem to be almost like sticking it to the Democrats. And why? I mean, there's some theories out there on like, is it access journalism, meaning they're being nice to Republicans because they figure Republicans will get in power and it's a good idea to be nice to them? I mean, there's all kinds of, when you look at the headlines, I just shake my head when I see these things of, one of them from the New York Times the other day, one of the conservative writers, so not crazy that he would say it, but that's where this comment came from is, will Democrats be permanently locked out of power if they lose in November? Well, if you're really worried about that, why are you not talking about how bad it is an idea to hire Republicans and how horrible their record is? So I just listed out a bunch of that stuff here. And there's a lot of good stuff happening. And the media is just not going to cover it on their own. They just seem to be caught in this loop, the doom loop of Republicans are coming back and I'd better be nice to them so I can talk to them when they're in power.
Yeah, actually,
very self-serving.
The public tends to pay a lot of attention to the unemployment rate. And it's worth noting, since we started tracking it, which is more like FDR or Truman era, that the unemployment rate has come down under every Democratic president, very marginally under Carter, and it's gone up under every Republican president except Reagan.
Yep.
I mean, the unemployment rate went up under both Bushes. It went up under Trump. It went up under Nixon and Eisenhower. Then my favorite, manufacturing employment goes down under every Republican president.
I've got to add that one to my litany of stuff to complain about Republicans. Manufacturing employment. I didn't have that one on my list.
It did.
All right.
It went up under every Democratic president until Obama, and it only went down under Obama because of the job losses early in his presidency due to being in the bottom of the Great Recession. And it took him 6 months to get out of the Great Recession. If you ignore the manufacturing losses in that period, we had manufacturing job gains under every Democratic president.
So yeah, feel free to slam Republicans at all times on their record. You don't have to pick on them personally. Just there are some statistics there for you of why you would vote Democrat, and ask the question, why would you think of the Republicans as a good choice from an economic or any other perspective? I get the single issue voter. I get that. If you're a gun person, abortion person, I get why you would vote Republican, but I don't get it for most people. Doesn't make sense.
They shouldn't be winning on the economy. A few other links here for people. And I dropped in the chat right before the break the link to this PowerPoint, and I'll go ahead and drop it in again just so that everyone can find it.
I'm just catching up on the chat, and then there's a comment. I'm just looking at some of the ones in the middle here. I see a Joe Gruber question, like the baby boomers never exceeded the actual quantity of people employed right now. Full-time employed never exceeded it. And then the jobs are literally 99% of the all-time record we had in February of 2020. So yes, it is amazing. Full-time people, highest level ever. And we're 99% of where we were right before the pandemic. that one slide that shows kind of the changes versus the pre-pandemic situation is one I hope you guys all share the heck out of, because that one is a, I was trying to find a way of showing the picture of where we stand relative to the pre-pandemic era, which is by all accounts, and especially since it's important to Republicans as sort of the pinnacle of Trump's economy. And they think of that as a holy site, holy place. Then we're way better off than that on most of these measures. It's going to be a big deal, hopefully next month, if we get back to 3.5 unemployment. And in maybe a couple months out when we're back, it may take 2 or 3 months to get back to that pre-crisis level. But being able to say we're at essentially record level on all of these things, better than 2019, is going to be a very big moment for us. 3 months out or so, we should be in a great place, hopefully, to market the heck out of that. You love what Trump did in 2019, you're going to really love Biden because he's better on everything. And we'll be able to say that in a couple months. We're just not quite there yet on a couple of those labor market variables, but we're darn close.
I guess an answer to that question about jobs and employment, we put up a couple of the graphics. This is payroll jobs. Now, there's something about Bill has his hand up. So what did you want to say, Bill?
With unemployment being so low and the amount of jobs that have been created, the amount of income that the federal government's getting in unemployment unemployment taxes, et cetera, and the amount that they're paying out for unemployment has to be a huge reversal in the last year or two. Are you seeing any indications of that happening?
I mean, other than the fact that the budget deficit's falling by over $1 trillion?
Well, we kind of heard we kind of heard from David early that was smoke and mirrors because it's a pandemic cost that Trump had.
We did not say it was smoke and mirrors. We say it was not due to any policy changes incorporated under Biden. It's the recovery from the pandemic and the recovery from the pandemic recession. It's the recovery from the 22 million jobs that were lost in March and April of 2020. And we've got 20 some million more people paying income taxes.
Right.
And,
Okay.
the improvement that Bill just talked about is just from that, not from policy changes. It's just from recovery from the pandemic.
Yeah. I mean, we could make the argument that the American Rescue Plan helped speed up the recovery. We didn't do what we did back in the Great Recession and start cutting the deficit way too early before we'd recovered the jobs, and which is why that recovery took so long. Anyhow, this is jobs, payroll jobs, and employment numbers. Oh, this is wrong one. Total employed. Let's find that. Total employed is just below the all-time high. We're at 158,458, and we were at 158,866 in February of 2020. And what David was talking about in terms of full-time employment, we're a little bit above where we were before the drop-off. And in fact, full-time employment had actually started to drop before the pandemic. It peaked in October of 2019 and was falling for a few months prior to that. That's if you go back and pull up the tapes of our meeting back in January or February of 2020, before we saw the impact of the pandemic, we were teetering on a recession pre-pandemic, based on some of the numbers we were looking at. And numbers like this would have been part of it. Question again, Bill?
Yes,
Carl?
two-parter. The first part of it is you have inflation and you have wage gains. And overall, it looks like it's reasonably close. Is there one segment of our society that is hurt the most by the inflationary increase and less of a wage increase?
I suppose low-income people who didn't have kids and get any assistance. Any low-income people who are not citizens and didn't get the checks would be suffering. You know, I mean, these are not huge groups of people, but yeah, the people who are not eligible for government benefits are going to get hurt the most if inflation is going up faster than wages.
Okay.
Because all the other
And
offsets help the citizens, don't help them.
Yeah, I had seen a statistic that said, what do they call restaurant workers, hospitality workers, had gotten one of the larger wage increases in the last year, 11-12%, which made me kind of think that would be the lower income. I'm not sure if that's absolutely true or not. The other piece of that is I know that during Trump's heyday, when he was getting low unemployment, he would point out how what the unemployment numbers were for the Hispanics and the blacks. Are we seeing any numbers for Hispanic and blacks that are getting down to those numbers when Trump was getting it down to 3.5 or whatever percentage that was?
Okay, so you want to look at unemployment rates. We'll get rid of all these graphs and we'll throw in unemployment rates for whites, blacks, Asians, and Hispanics. Throw in and see what we look. So the unemployment rate for African Americans is at 6.2%. Under Trump, just prior to the pandemic, it was 6.3 and then 6.0, but it had gotten down to 5.4% in the middle of 2019, and it had actually gone up half a point or more before the pandemic. For Asians, we're about where we were pre-pandemic. And for Latinos, but we're not quite there. I mean, and for Hispanics, I mean, we're actually 4.2% is a little lower than the 4.4% in February of 2020. So we're
nice. Thank you.
I can share that one in our next meeting. I've got the Fred chart for that we share from time to time. It's pretty much all the races are following the same trend. They're getting very close to where they were pre-pandemic. And let me share something here for a second, Carl.
sure.
Bear with me here if I can figure this out. Hopefully you guys will be able to see this. Can you see this budget table here?
Yes.
All right, so this is the CBO budget table. This shows the budget deficit and the components October to March. So October is the first month of this fiscal year. If you look at receipts, they're up by about $400 billion over that period of time, and the outlays are down $600 billion, and so we're $1 trillion better on the deficit than we were last year. So 1706 versus 667 is where we are just through these months. So this is
So it's come down $1 trillion in half a year.
Yeah. So I mean, it's really coming down fast, and the receipts are are coming back. Is a big part of that is you can think of the outlays as a big difference is that we're not doing quite as much of the pandemic relief, but the receipts are what Carl's been talking about with the economy recovering, millions more people at work. You're seeing some big revenue numbers come in. But yeah, we're already $1 trillion lower than the comparable time period in the prior year. And this number should, the estimate that I've got from the CBO is it should be, we're going from for the full year, we're going from 2.8 to 1.2. So it's a 1.6 trillion drop. We're $1 trillion of the way to that 1.6 if that CBO forecast holds. All right, Carl, back to you. I am stop sharing.
Well, I'm not going to share anything until people have things they want to go look at, but I'm certainly willing to keep talking to everybody.
Yeah, if you've got questions, bring them up. We'll look at it. I see some people picking on Trump about his net worth. Yeah, I thought that he was supposed to release his tax returns, but they keep managing not to quite do that. So I don't know what bucket he really belongs in. And the ships off of China is an interesting one. There's all these. One of the interesting things is Carl and I spend a lot of time on these, and so do most economists, on these aggregate measures. And sometimes we'll dig a layer down into the different income groups, like we showed you. We do income distribution stuff and wealth distribution stuff from time to time. But there are a lot of these new measures that are coming out. These more real-time measures, like the reservations in restaurants and the number of people that are traveling through the security stations in airports. I mean, there's these different, and we had those in for a while because we were doing we always had a section about the virus, but we're probably due for bringing some of those back. But it's interesting to see those statistics sometimes, these kind of more real-time new measures that have some good meaning for different sectors of the economy. And we can drum some of that back up. I haven't looked at the security one in a while. And Bill, on your question about the wages, sort of which groups are getting hit harder, we had a couple slides in there on showing that almost every distribution, every group is up $5,000 or $10,000 or more. If you think about what sort of, and I drew a diagram of this, I don't have it handy, but if you have assets, meaning if you have stocks, you have housing, stocks were up 40% since before the crisis, housing's up 25% or $50,000 for the average home. If you own a house, and about 2/3 of American households do, and if you have stock, which about half of Americans have it directly or indirectly with their 401k, you got a big benefit from that. If you were somebody that got the wage gains, which are more than inflation measured before the crisis, or not quite as much, but close, since in the last year under Biden, if you got those big wage gains, you had that helped a lot. And then if you got the checks, and if you had more family members, if you had a 2-adult household, you got 2 rounds of checks from Trump. You got 2 doses of 2 checks from Trump, 2 checks from Biden. And then for all the kids you've got, you're going to see those child tax credits expanded. So for a family of 3 or 4, or 5, 2 adults and a kid or more, you're going to see a lot of checks coming in there. So between the checks, wages, and the assets, if you hit on all 3 of those things, you had a really, really good 2021. And if you hit on even 2 of them, you probably had a really good 2021. And if you only had 1 or you missed it entirely, then you didn't. And the checks went to almost everybody. 70%, the bottom 70% got them. And Carl's point, if you didn't file a tax return, or if you're undocumented immigrant, you didn't get the checks. But the checks alone will get you pretty much ahead of inflation all by themselves. I've seen different studies on this. Inflation's 300-ish a month, and now I'm hearing stuff that's more like 500 or 600 a month. But I haven't checked that to the sources. I'm just seeing that noise come through from Republicans. But if you hit the trifecta of assets, wages, and checks, you had a great year, and the vast majority of families hit at least 2 of those.
Okay, David, this is a chart from Biden's budget, historical tables showing the projected deficit for the current fiscal year at 1.4 trillion, up from the CBO's forecast of 1.2 trillion.
There you go. Thank you. Okay. Yep.
And again, based upon the numbers that we were just looking at, I'm not sure it's gonna come in at 1.4 trillion. You know, it'd be interesting to see if it can beat this number or even come in lower than the 1.2 trillion. But this is where my comment came from.
Yeah, no, thank you. Here, let me share again here for a second. Here's that 3-circle slide. I took it out of this month's presentation, but I think, can you guys see this?
Yes.
All right, so if you had assets, this is for 2021. So stocks were up 27%, owned by half of adults. The average 401k is up 10 grand. Homes were up 14%, owned by 65% of households, average home plus 50. The net worth set a record of 150 trillion. And I think that's through, that one usually lags, though. I think it's through the third quarter. So it's probably even more through the fourth quarter. So that's the asset side. And, you know, a lot of people missed out on this part, that's for sure. But there's a lot of people that didn't. Now, if you, in terms of getting checks, if you were a 2-adult household with kids, each of the adults got 1,400 and 600. So 2,000 per, that's 600 from Trump, the 1,400 is Biden. So 2,000 times 2, that's $4,000. And then you also got the monthly child tax credit. Now, this is not incremental to prior law. It's either 1,000 or 1,600 per kid incremental, depending on the age of the child. But these were the size of the checks that people were getting. So figure, you know, more like 100 and 100-ish a month to 150 is incremental that people got. And then if you got a raise, wages were up 6%, or about 3,000 for the typical production and non-supervisory worker. And different estimates that I've seen, let's use 300 a month for inflation, that's 3,600 a year. Wages kept you in the ballpark. Checks more than did that. And if you got in the asset boom, you really hit it big. So, you know, if you think about, I don't have a statistic that shows me how many people are in each of these chunks of this graphic. So this is not to scale of any size, but, you know, the bottom 80% got the checks. A lot of those lower income workers, like you mentioned in the restaurants, got the big raises. And and then if you were a little wealthier, you got the asset boom. So it was a heck of a good year, 2021. To me, if you are a policymaker and you really care about inflation, like for example, Manchin has said many times, I don't want to do BBB because I'm worried about inflation. Never mind that that's a horrible argument because it's funded by tax increases, so it doesn't really affect the deficit very much. So it's probably not going to be inflationary one way or the other. But that, if you were to extend this child tax credit, again, that would help address a lot of the impact that's going to be caused, because this 300 a month is going to continue. We don't know if the raises are going to keep up at this rate. We don't know if the stock market's going to do what it did. But if you could do something in the checks department, you could certainly address a lot of that damage. So when people say, I care about inflation, I don't like what Biden's doing, blah, 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 the science would tell them, do Build Back Better so that you can get some checks to people and make sure that, you know, the bottom 80% is sort of insulated from that inflation. Because if you're also taxing and not increasing the deficit, you shouldn't be making inflation any worse. At least that's the theory. So when I hear Manchin make the inflation argument or the deficit argument, I just shake my head and, like, you know, BBB is not going to increase the deficit. BB is probably not going to drive much inflation because it's funded. So what's your argument? Your whole argument is gone. But yeah, as long as these 3 circles are running in your favor, you had a heck of a year. All right, I'm going to stop sharing. All right. I guess we're at almost 9:30, Carl. Do we want to wrap it up? And I'm going to drop off too. If there's any more questions, you know, you can always bother us between the meetings. We love to research this stuff and share it. So don't feel like you've got to ask a question here. You've got to wait a month. Let us know your thoughts in the middle and we'll get on it. Good night, guys. Thank you. Always fun.
Good night.
Good night.